Good afternoon and welcome to the February 2023 Executive Committee meeting of the Board of Education Retirement System. Today is Thursday, February 16th, 2023, and the time is 1:05 p.m. As a reminder, please note that the committee meeting is being recorded and will be posted to the BERS YouTube channel. I will start the meeting by calling the roll. Cherie Gibson.
Present.
Thank you. Anthony Giordano.
Present.
Thank you. John Matterich.
Present.
Russell Buckley. We'll note that he's on camera. I think still waiting for his microphone to be able to go. But Russell Buckley is in attendance for the Chancellor of the Department of Education. We have a quorum. I'd also like to note for the record that also in attendance are board members Allison Hirsch, John Dorsha, and Nafeed Hassan. The first item of business is to consider the minutes from the Executive Committee meeting held on Thursday, January 19th, 2023, a summary of which was included in your packets. May I have a motion to consider the minutes?
So moved.
Thank you, Tony. May I have a second?
Second from John.
Thank you, John. Any discussion on the January 19th, 2023 Executive Committee meeting minutes? Hearing none, may I have a motion to approve the January 19th, 2023 Executive Committee meeting minutes?
So moved.
Thank you, Tony. May I have a second?
Cherie, second.
Thank you, Cherie. All those in favor, please say aye.
Aye, Cherie.
John.
Any
Aye,
opposed?
Russ.
Thank you. Any opposed? Any abstentions? The motion carries.
Antonio, you can hear me now?
Yes, we can. Thank you,
All
Russ.
right.
All right. The next item of business is to consider the minutes from the special executive committee meeting held on Wednesday, January 25th, 2023, a summary of which was included in your packets. May I have a motion to consider?
So moved.
Thank you, Tony. May I have a second?
Second.
Thank you, Cherie. Any discussion on the special executive committee meeting minutes? Hearing none, may I have a motion to approve the special executive committee meeting minutes held on January 25th, 2023?
So moved.
Thank you, Tony. May I have a second?
Second from John.
Thank you, John. All those in favor, please say aye.
Aye, Cherie.
John.
Any opposed? Any abstentions?
I'm going to abstain. This is Russ.
Thank you, Russ. The motion carries. Before we get into our first discussion, I would like to note a few changes to the order today for executive session. Instead of having the manager waiver discussion first, we are going to discuss the investment managers for consideration, since the manager waiver discussion will need to happen with our consultants out of the room. Second, I mislabeled the manager report waiver discussion for action when it should just be for discussion. All right, with those items out of the way, our next item up for business is the discussion on the net zero implementation plan. May I have a motion to consider?
So moved.
Thank you, Tony. May I have a second?
Second from John.
Thank you, John. With us today, we have Mr. John Adler, Chief ESG Officer from the Bureau of Asset Management, here to discuss the proposed net zero implementation plan. Some of you may have seen portions of this presentation yesterday at the joint NYCBERS manager presentation meeting. Before we begin, I'll just say that this plan is one of the most important discussions that I think BERS is going to have all year, and along with the other two retirement systems, since it crosses asset classes, engagement, portfolio construction, and to the extent that the implementation plan changes portions of the appendix of the BERS investment policy statement, it will require a full Board of Trustees approval, which we will take up at the March meeting. With all that in mind, I turn it over to the esteemed Mr. John Adler. So, John, the floor is yours.
Thank you, Antonio, and good to see those of you who I've worked with for years, and good to meet the new folks that I don't know. Is it okay to share my screen?
Absolutely.
Okay. There we go. Can you see it?
Good
Yes.
to go.
Okay, great. Okay, so this is the net zero implementation plan, the proposal, a little bit of history here. In October 2021, BERS, along with, let me just say, NYCBERS and teachers, set an aspirational goal to achieve net zero greenhouse gas emissions by 2040 across your investment portfolio. to mitigate the systemic risks of climate change and to take into account the best available scientific knowledge and fulfilling fiduciary duty. Two pieces of that were adopting the net zero asset owner commitment of the Paris Aligned Investment Initiative, and you adopted a preliminary climate action plan that required the development of a net zero implementation plan in a year. You'll note that here we are in February, so it's more than a year. As we informed the trustees in October, we took longer than anticipated to put this plan together. As Antonio said, it was a lot of work, and we wanted to get it right. And so I think the trustees were okay with us taking more time to try to get it right. By the way, I can't see everybody on the screen, so if you have a question while I'm presenting, just call it out or you know, whatever, and I'm happy to take questions as we go. Okay, so first, a broader framework for this. The goal here is not to just decarbonize our portfolio, it's to decarbonize really the global economy, which we can't do by ourselves. But that's the approach that we're taking in order to keep fossil fuels in the ground, because really to mitigate the systemic risk of climate change, it's not just about getting emissions out of our portfolio, it's getting the emissions to not happen in the first place, right? So that's what we're trying to do with this plan. And obviously, we can't do this alone. BERS can't do it alone. The New York City retirement systems can't do it alone. We have to do this in collaboration with governments, regulators, companies, and investors across sectors if we're going to succeed in keeping global temperature rise well below 2 degrees centigrade. So all of that underlies this plan that we're presenting to you today. So this is the highlights of the plan in one slide, and there's a lot on here. And what I'm going to do is go through this, but then go through each of these boxes in detail. So the first piece is disclosure on the upper left, and we're planning to annually measure and report the BERS public portfolio's scopes 1, 2, and 3 emissions and the progress that we make each year. Now, let me just ask a question right off the bat. Would folks like me to go into an explanation of scopes 1, 2, and 3? Because that underlies a lot of this, and I can do that right now on the next slide if that's of value. Somebody needs to call out. Yes,
Yes, please.
Okay. All right, so if you look at this next slide, slide 6, and look at the chart on the right-hand side over here. So scope 1 is the direct greenhouse gas emissions that comes from a company's own facilities, their plants, their offices, whatever it may be. You know, think about this as the smokestacks coming up from a factory, right? So I like to use a auto manufacturer as an example. So the you know, the emissions that the auto factory itself generates, that's scope 1. Scope 2 is really the electricity that's needed to power those facilities. So again, whether offices or stores or factories, the electricity, the greenhouse gas emissions that are generated by that electricity is scope 2. And so a company that is primarily relying on, say, coal-powered plants for their electricity is going to have higher scope 2 than a company that's primarily relying on renewables. And I'll note that, you know, many of the large tech companies that run giant server farms like Facebook or Google or you know, whatever, Amazon, for example, those server farms, in many cases, they are purchasing renewable energy to power the electricity to run those servers. So that lowers their scope 2 carbon footprint. Scope 3 falls into really 2 categories. The upstream, which is primarily their supply chain. So if you go back to the car company the emissions generated in creating the steel, the rubber, the leather for the leather seats, the chips for the computers, the onboard computers, all that stuff. That's their upstream scope 3. Downstream scope 3 is the emissions that are generated by the use of their products or services. So again, with the car company, the emissions that the cars themselves generate when the customers drive them is their scope 3. So if a car is making, if a company's making electric vehicles, their scope 3 emissions are going to be lower than a company that's making vehicles that are strictly internal combustion engines, right? So, this gives some more details about the scope 3, the upstream and the downstream, but that's sort of the way to think about it. In general, scope 3 makes up 75% of global emissions, right? It's much larger than scopes 1 and 2. But the other thing about scope 3 that makes it tricky is that not all the scope 3 emissions are ascribed to a single company. So if you, again, going back to your car, right? So some of the scope 3 is going to be the car manufacturer, but some of it's going to be attributed to the gasoline company that you bought the gas from, right? That's also scope 3 for the gas company. And so part of the methodology for calculating scope 3 is parsing out how much of it belongs to, which companies in that value chain that leads to the emissions. Okay. So any questions on scopes 1, 2, and 3? Okay. So I'm going to go back to the previous.
I guess you can't see me. I'll have a quick question.
Yes.
At the risk of sounding unpopular, it might be just my naivete here. I'm just trying to understand. I would completely understand how, let's say, if a coal miner comes to the, to us and says, I have this huge coal mine I want to open. I need to raise money. This is an IPO, or even a secondary offering. I can see that if we don't invest, that makes a difference. But if a company is already in existence, like the stocks or whatever, they're already there. Does it matter if we or other companies invest in them or not? I don't see how it might lower their valuation, but other than that, does it really stop them from doing what they're doing?
So, Effie, what you're really talking about is the divestment, the question of divestment. This net zero plan is not a divestment plan.
Okay.
It's mostly an engagement plan. So I think as we go through, we'll answer your question. But if it's not answered by the end, please ask it again. Okay, is that fair?
All right, sure. Thank you.
Okay. I will note for those of you who weren't here that in 2021, BERS voted to divest from certain fossil fuel reserve owners. And actually voted to divest from pure play coal mining companies back in what, 2016, Antonio, is that right?
Yes, 2016.
Right. And those divestments were really about risk and not trying to reduce the risk of stranded assets to you as asset owners. So, but that's really an aside. It's not the.
I have a question.
It's not the point of this plan.
I have a
Yes.
question. Do we have any numbers on what the impact of previous divestment has been on the fund?
The short answer is no at this time. I mean, we know how much we've divested, and maybe Antonio has that answer. I don't know. Do you, Antonio?
Yes, so and we did calculations. I'll have to update them, but the last time we measured it, I think the impact was somewhere in the neighborhood of 50 to 60 basis points. As you can imagine, and that's on the public equity portfolio. Through the entire divestment, between those 40 companies, obviously, oil and gas stocks had kind of a banner year last year. But that's over that time period. And I think more important than even that, I think the BAM risk teams, their assessment on ex ante tracking error is about 75 basis points for the public equity portfolio.
I'm assuming that's loss. It's negative.
Yes.
It-
Well, no, not the tracking error. Obviously, the last year, the actual stock kind of the return impact was negative last year. Obviously the tracking error is going to be the standard deviations.
Got it. Thank you.
Okay, so I'm going to continue on this slide 6. I covered a couple of these points in the summary already. So we'll annually measure and disclose greenhouse gas emissions of your public portfolio. So this only applies to the public markets portfolio, public equity and corporate bonds, covering scopes 1, 2, and 3, financed emissions. BAM will also evaluate tools and data for measuring emissions of private markets. So we don't have the tools right now to give you a complete picture of the private markets portfolio, but we intend to do that and see what's out there and see when we can get to a measurement that we have confidence in for its accuracy. We're also going to evaluate tools and data for assessing additional climate risks, such as physical risk, transition risk, and look at scenario analysis. Scenario analysis is what happens to your portfolio if climate change goes above, say, well above 2 degrees centigrade, and what happens if it's below 2 degrees centigrade, and it can obviously have different impacts on different parts of the portfolio. And we'll be doing an annual report for you on these issues. Okay, I'm going to move on. All right, so this is the heart of the disclosure piece. So your portfolio went down 16.33% between the baseline, which was 2019, the fourth quarter, and the end of the last fiscal year, the second quarter of 2022, 16.33% during that time. The benchmark went down 24%. So the benchmark decreased much more than the BERS portfolio. The reason for that really is active management in the BERS portfolio. And so, I think unintentionally, but for whatever reason, your managers are exposed to sectors and geographies and companies that have higher GHG emissions and had lower reductions over the last 2.5 years than the overall benchmark for your public markets portfolio. What we are proposing is that the BERS board set targets of 22% reduction. So that's from 2019. So you're already at 16.33, and then you would get to 22% by 2025 and 49% by 2030. I'm going to show you a graph with this in the next slide, but let me just make these last 2 points, which is that we are not proposing emissions reductions targets now for scope 3. We are, the appendix of the plan itself has the scope 3 emissions, but the data which comes from MSCI, we only have for 2022. We don't have any earlier data. So I don't feel like the data is robust enough to set an emissions reduction target for scope 3 yet. And it's also not robust enough in private markets. So we're not proposing goals for anything except scopes 1 and 2 public markets data. So here's this graph. And so if you look here, you see here's the reduction from the end of 2019 to the middle of 2022. That's the 16.33%. We're then proposing that by 2025, you reduce from here 22%, right? So from 100 to 78. And you can see that the slope of reduction from now until 2025 is much less than the slope here. So we're saying that reductions, the emissions reductions will not be as great on an annual basis between now and 2025 as they were between 2019 and 2022. But then they start to pick up the pace again between 2025 and 2030. And then, we're not setting interim goals from 2030 to 2040 yet. Feel like you need more data and see where things are at that point. So that's the proposal that we're making that you adopt. I will say this, your emissions reduction was materially lower than that of NYCBERS and teachers, the other two systems that adopted net zero by 2040 goals. And so the targets that we're proposing to you are also not as low as those for NYCBERS and teachers. They're slightly higher to account for the fact that you're kind of starting from a higher point.
Question, John.
Yes.
So, yeah, I'm supportive of the initiative 100%. In fact, I was just talking to Tobias Reed from Oregon about
Yes, he's doing it too, right?
his post. So I'm 100% supportive. But in line with this, I'd like to know if we've done back testing on what the numbers would be like, because ultimately our first responsibility is fiduciaries to the fund. So I would love to see correlation of maybe back testing or like money manager would do in terms of providing us what the impact would be on the portfolio by removal of the or the lack of engagement or whatever the mechanism is for disengaging would be on the portfolio during these times, if there's such.
So again, let me just say, this is not a divestment proposal.
Right.
We're not proposing any divestment. And in a minute, we'll go over the mechanisms that we are proposing for how to achieve these reductions.
Gotcha.
Okay, so there's no divestment in this plan. We did divestment, or BERS did divestment. It voted for it in 2021, was carried out mostly in 2021, I think, Antonio, right? So again,
Yeah, so we did April 21 out of U.S. equity, and then out of international equity and in bonds, both IG credit and high yield by December 31st, 2021.
And it was a net, and it was a potential out, 75% to 60%, 60 bips, sorry, 75 to 60 bips negative to the portfolio.
That's 60. Yeah. That's the public equity portfolio. I should say.
Public equity portfolio. Okay,
Yeah,
gotcha.
it's a little bit tougher to do for fixed income.
right, to be fair about it, the ex ante prediction was not a reduction, but a either no effect on returns with a slight reduction in risk. And look, we're looking at long term. 2022, as Antonio said, was the best year for oil and gas since, I believe, 2014. So 2014 to 2021, oil and gas underperformed. It was actually the worst performing sector for all time periods, 1, 3, 5, and 10-year time periods as of 2021 in the entire market. And then in 2022, it reversed, right, where oil and gas was the best performing sector, really the only positive sector in the entire public equity market. So, that nobody would have predicted that at the time that, and of course, markets are uncertain. We know that. But I think in the long run, it is the expectation that this will pay off, that the divestment will pay off because the markets are not accurately pricing the stranded assets risk embedded in these companies. So,
Hey, John,
again,
just
I don't want to get into
two
a whole
questions.
argument about divestment because that's not what this is about. Yeah, sure. Go ahead.
Two questions, John. So NYCBERS
carbon depletion or whatever, however we refer to it, reduction was greater than ours.
Yes.
Do you have any insight into why that is? I mean, I know the real
Yeah.
distinction is we are more aggressively indexed. Do you have any insight into what might have been driving that difference? Antonio may have some
Yeah,
thoughts on that.
look, we divested from fewer companies than them, right? I think that's probably the
Yeah.
largest. So it's a combination there. While we are 90% indexed in U.S. equity, we are 100% active in international, right?
International.
And so
Yep.
that so that kind of that split as well. In high yield, as an example, we split between kind of less kind of neutral or kind of balanced, and with Nomura we have a more aggressive. They tend to be more aggressive in their allocation, so they tended to have a little bit higher allocation to energy. And so I think John's point around in areas where we've had active management, oftentimes that right, rather than necessarily optimizing around a particular index, optimizing for tracking error, we're going to have managers who are making decisions on essentially how not to lose out on some of that performance. And so I know, for instance, we showed that we were overweight certain midstream companies, right, after the divestment. And so I think it's a combination of we had our list is smaller, and the active management decisions of our international and fixed income managers.
Okay, and then the other follow-up was the Makita study. I mean, actually, this is more directed at trustees. The study that was contracted by the city is dated October 30th, 2020. That hasn't been updated since, has it, John?
Nope.
Okay, that's something we should probably share with trustees so they understand what the basis of the decision of the previous board was based upon. And it is, to quote Mr. Adler, you know, no one knows what the market will do, and the market did something that was probably way in excess of what Makita anticipated. Well, it was definitively way in excess.
Yeah, what anybody anticipated, truthfully. I mean, you know, just so you know, we had at a different board, we had Makita and BlackRock didn't anticipate it either. You know, I don't think I don't think Siegel Marco did. Nobody anticipated that. So,
Yeah,
and again, it's 1 year. We shouldn't. This is a long-term investment policy, and I don't think we should judge it based on 1 year's returns. We're long-term investors, but certainly that year was, if you wanted to, you know, time your divestment worse, you couldn't have really.
Yep. And we'll share that study. We'll send it around.
Okay, I'm going to move on.
Sure. Thank you.
Sure. And please continue to ask questions, everybody. So this goes to the heart of how we intend to achieve these targets. It's not through divestment, it's through engagement. So with portfolio companies, this is the key right here. Our goal that we are proposing to you is that 70% of the scope 1 and 2 financed emissions in your portfolio will have science-based targets by 2025. So what are science-based targets? That's this bullet here. They are approved by the Science Based Targets Initiative, which is a global NGO, non-governmental organization, or otherwise independently verified, with globally established science-based targets in order that reflect the latest climate science in order to achieve the goals of the Paris Climate Accord to limit global warming to well below 2 degrees centigrade or 1.5 degrees. So if you look at this today, 16% of your portfolio's financed emissions, scopes 1 and 2, are covered by science-based targets. There are 66 high-emitting companies in your portfolio that if they adopted science-based targets, you would get to that 70%. So it's not a sort of giant universe. We can focus our engagement on, you know, we won't just do these 66 companies because we're not going to bat 1,000, but, you know, we'll focus on the limited universe of the highest emitting companies and basically engage them to adopt science-based targets in order to achieve this goal. So that's the real engagement. That's what's going to happen with the portfolio companies. Then the goal is that by 2030, 90% of scopes 1, 2, and 3 financed emission in the portfolios have SBTs in place. So that, to me, that is the meat of how we would seek to achieve these goals, is the companies that are putting the greenhouse gases into the atmosphere, we want to engage with them and get them to adopt science-based targets to reduce their emissions. So, and then the bullet at the bottom of the page is we want to explore methodologies to assess the net zero alignment of portfolio companies based on how well aligned their plans and capital expenditures are to achieving their science-based targets. Because the targets is one thing, but then you have to develop a real plan to achieve those targets. And one of the criticisms right now of frankly, the global economy is that there are many companies that have set net zero goals, but are still acting as business as usual and are not actually taking action to adjust their operations to achieve those goals.
Yeah, John, that was my question. So I get it. I understand the engagement. My question is how do we engage?
Yeah.
And I guess, our state of Oregon, NYCBERS, comes together and says something clearly, but the hammer I'm supposing is at some point divestment. Do we have kind of a plan of if we're net zero all the way.
Yeah.
And they do nothing, what becomes the hammer and what becomes the ultimate maneuver? And is there a process, a procedure, 3 engagements, 4 engagements, show something, what's the nuts and bolts of that work? How's that work?
Well, so, I mean, this is what I would say to you. Engagement can take many forms. It includes, letter writings, meetings, that kind of thing. There's Climate Action 100 Plus that we're part of that engages with companies. We'll do it with, Oregon and lots of other institutional investors. It also involves filing shareholder resolutions. And so, New York City is one of the most active filers of shareholder resolutions. We have a very active, and have for decades, by the way. That's not something new under this controller. That's been going on since the days of Jay Golden. So we'll do shareholder resolutions. In terms of the ultimate thing, what we ultimately, yes, there will be a question about divestment that we would bring to you, to the board, and say, okay, this company or what have you has refused to budge, and this is all the things we've done. Here's the criteria. And so do you think that we should continue to hold this company? Should we underweight it, or should we eliminate it altogether from the portfolio? That can be an ultimate hammer, and it's provided for in here. We'll get to it. But it's not what the primary plan is here. And we wouldn't expect to do any divestment in the near term before we really let engagement, try our hand at engagement.
Don, quick question. This is Effie Zachary. Do any of the nicer funds have any people who sit on any of the boards that we invest in, companies that we invest in?
No. I mean, right. I don't think there's any trustees of any plans. I don't know, Mr. Rich, do you sit on publicly traded boards of any companies that we're invested in?
Not that COIB has notified me of. No.
Okay. So I think the answer is no.
Well, clearly that's one venue to have some influence, but please continue with your presentation.
Yeah, anyway, okay, I'll let that be. Thanks. All right, I'm going to move to the next slide. So this sort of summarizes what I just said. We're going to prioritize the high emitting companies in the indices, in the highest emitting sectors, which you see listed here, and We're going to continue our work with Climate Action 100+, which is collective engagement of the highest emitting companies. We're going to engage financial institutions that did what I just said. They've set net zero goals, and they continue to lend billions of dollars to new fossil fuel supply projects. And we're also going to be pushing companies to measure, report, and set targets for their scope 3, because that's a key part for the 25 to 2030 portion.
And 75% of the emissions come from scope 3, correct?
That's right.
Okay.
Okay, so that's the companies. Now I'm going to move on to managers. So what we're planning to do with your approval is ask all of our managers to adopt a net zero goal or science-based targets and an implementation plan consistent with fiduciary duty for, at a minimum, the assets they manage for you, but we'll ask them to do it for all of their assets. And that we're going to do that, we're going to ask them now and then ask them to do it by 2025. We want managers to cover scopes 1 and 2, material scope 3, which is defined as if scope 3 emissions exceed 40% of the total emissions of the portfolio, then that's considered material. If they don't have adequate data on scope 3, to develop a plan for that, which is, that's a fine thing to say now. We're doing the same thing. And then in the private markets, so some of the private markets managers say, look, you guys are in a fund with that's a 10 or 12-year limited partnership. We're not even going to own anything that we own now in 2040 or 2050. How can we set a net zero goal? And so what we would say to, now some managers have set net zero goals, mostly European managers, like EQT or I don't know, I can't think of others at the moment, but a number of them have. But for those who won't, then we would say to them, okay, for the investments that you control, have those portfolio companies adopt science-based targets while you own them during the holding period. And frankly, that would have even perhaps more of a real world impact than them adopting a sort of, net zero by 2050 sort of goal, because it's, here and now brass tacks. That's for control investments. Moving down, we don't yet have a proposal for private markets non-control investments, such as alternative credit or growth capital. So we want to develop a proposal for that. We'll talk to the managers in those spaces and see what we can come up with. We also intend to review the proxy voting records of public markets managers. Now, we've never done that before because we vote our own proxies. Our managers don't vote the proxies for us, but they still vote proxies for all the other assets that they manage. And we want to take a look at that. If they manage mutual funds, it's public information, and most of them do, but some don't. So we'll ask them for that information and, scrutinize it. And so then we plan to provide you with an interim report this year, a more in-depth report on the managers next year. And then in 2025, if there are managers in your portfolio that don't set targets or make plans or some other, alternative approach, we'll come back to you and say, okay, manager X isn't doing this. Here's our recommendation, but you guys should decide what you want to do.
John, can I ask a question? It's
Of
Vanessa from Sigo Marco. Is the Bureau of Asset Management intending to include some of this net zero language in the RFPs for listed managers? And what's the plan for managers that are, or searches that are currently ongoing and have not been presented, or a finalist have not been, presented to boards?
I would say that I believe the answer is no. And the reason is this. First of all, this plan hasn't been adopted yet by any of the boards, so we can't do anything until you guys adopt the plan, vote for it. Secondly, what we're intending to do, so you may know, we now perform ESG diligence on all the managers, and when you get the investment memo from the Bureau of Asset Management, it includes a table that lists their answers to a bunch of ESG questions that we pose to them, including questions about climate. Do they set goals? Do they have a net zero plan? Do they measure emissions and that sort of thing? We have not sort of unilaterally decided to put it in the RFP. One thing I'll just say is that as you may know, the procurement process for public asset managers, which is the one that that's how the RFPs are for public markets managers. That's a collaborative effort among all 5 boards, so that the consultants for each of the 5 boards, including Siegel Marco for you guys, and the general consultants for the other managers, are the ones that make the recommendations. And as you may know, police and fire have not adopted the net zero by 2040 goal. So I don't think they would agree to include that language in the RFP. Instead, what we're planning to do it is through, first of all, an annual questionnaire of the managers, where they, we'll ask these questions directly and they answer. And then we'll directly have conversations with them as well. So I don't anticipate it going into the RFP.
Okay, I was wondering if there are managers that may not be able to meet those targets, that at the RFP level, we can kind of like pull out because they already know that they're not going to be able to meet those targets. Rather than being a manager that you hire, engage, transition assets, and then something happens a few years later.
Right. It's an interesting question, Vanessa, which honestly I haven't considered. I don't know, Jimmy Yan, who's on the call, is our team member who's been most involved in searches with RFPs. Jimmy, thoughts on that? If you're on mute, if you're.
Can you hear me? Sorry,
Yeah,
sorry
now
about
we can
that.
hear
I'm
you.
remote.
Yeah.
Yeah, I think, well, we have been, as John mentioned, we're asking a question. The question is actually embedded in the ILPA for private markets. We use this, industry-wide template for a due diligence questionnaire and adding some of our own. And this industry-wide template actually already asks, do you have climate commitments for reducing emissions? Do you measure your emissions? And we're asking all managers about that indeed. And they're emphasizing that question. And for the managers that don't have commitments now, I would say all of them are very receptive to continuing the conversation with us to explore developing some sort of climate commitments that are appropriate for their strategy. And so we also don't want this to become a barrier for smaller, newer managers, right? And so we will look at this on a case basis. I mean, the goal applies evenly to everyone, but we could put in a little more effort and do a more of an analysis of how, if it's a smaller manager, for example, or a manager in an asset class, that's where it's difficult. Work more closely with them on ways to to similarly achieve our goal.
Yeah, I just think it goes to Tony's question on, once you're down the line, what do you do if they still do not meet the target that you asked? So maybe this, we don't need to answer this right now, but maybe just give it some thought of how we want to implement it in also the portfolio construction part of this, for public markets.
Makes a lot of sense, Vanessa, and we will definitely put that into the hopper and give it consideration. I think it makes a lot of sense. Thank you.
Has there been, you mentioned the survey earlier, and I think EQT, which I think we're discussing later today, was in line. what's been the general consensus or the feeling that you've gotten back from money managers in terms of like, this is impossible, or this is, yes, we're willing? I would assume no one's going to tell you it's impossible when you're talking to them,
Right.
because they want an allocation at some point. But in general, what's been kind of the feedback?
Jimmy, you
I
want to?
mentioned that based on our surveys of, and we're gonna update. One of our plans is to sort of provide an interim update later this year. But we have a preliminary set of results from our survey, which show for BERS specifically that it's like very close to 100% of your primary managers and public markets managers responded. About 61% currently have climate commitments or have specifically said they're planning to make a commitment in the next 12 to 18 months.
That's promising. I have a question. Well, this is a dollars and cents question. This seems like a lot of work so in terms of budget, what is it going to mean in terms of staff person or staff people dedicated to this initiative? Because this is ostensibly hiring another consultant and a staff person to manage that consultant. So just in terms of dollars and cents,
Yeah.
where is it? Is there some federal grant or
we have a team, and in addition to Jimmy and I, and folks maybe can turn your videos on, we have Neha Naim, who joined in October. We have Jamie Statter, who came to us from the Policy Bureau of the Controller's Office and is Senior Climate Policy Advisor. Neha is ESG Strategy Officer for Climate Change Metrics. She is a PhD in finance. What's the specific, Neha? You're on mute. Sorry. We still can't hear you, so something's gone on. But Neha has a PhD in finance and was teaching climate finance at the SUNY School of Environmental Studies and Forestry before joining us. And then Tara Mae Smith just joined us last week, or the week before, I think the week before, as our newest hire. She's ESG Integration Officer. And so she's going to be working on this manager piece in particular, and working with our managers, both current and prospective, around ESG integration overall, including the climate piece. And Tara Mae has an MBA from Stern and has done a lot of sustainability work before coming to us. So we have hired folks in. The controller is very, very committed to this. And has been, very involved with us in working on this plan. For those of you who were on the trustee Zoom with him in October to discuss this, he stayed on that call for about an hour and a half. He's really engaged and educated on it, and he really wants BERS, teachers, and NYCBERS to be leaders in this space. And so he, basically has said, okay, these are the resources you need. Go out and get the best people. And I think we have a really good, strong team. And we are, I don't know if I've said it yet, but we're going to be looking at data sources where we may need to spend some money to get the best data sources on climate that are out there as well in order to do this work.
Right.
Okay, I know I'm running short on time. I think that's why Antonio's probably showing up. So I'm going to try to
ask your questions.
Okay. Okay, so the just transition is part of your commitment that you made in 2021. We're going to be assessing approaches for evaluating how investments support a just transition, and we'll come back to you in the fourth quarter of this year with recommendations about how to incorporate the just transition, environmental justice into your investment process. And then climate change solutions, this slide is, there's no change here. You guys made the commitments to these goals in 2021. The only new number here is the number at the top, which is the amount of current exposure you have to climate solutions, which is 201 million or 2.6% of your AUM that's as of the end of the fiscal year 2022. The 2025 goal is 400 million and your goal by 2035 is 1.8 billion. And if you decide to do an asset allocation review this year, we would like to, in the course of that review, think about how we can prudently increase allocations to climate change solutions across multiple asset classes, consistent with fiduciary duty and your investment objectives. And really, I already, oh no, I didn't talk about the private markets exclusion. So when you did the fossil fuel divestment about 2 years ago, you also directed BAM to come back with a proposal for how to apply it to private markets. So this top bullet point is the proposal on that, which is that we ask your private markets managers prospectively, not the existing ones, but ones to come, to exclude exploration, extraction, and production of oil, gas, and thermal coal, or provide you with an opt-out. This should not be a heavy lift. What our private markets asset class teams are saying is that basically the managers are not doing this anymore. It's just, it doesn't meet their risk return objectives. It's too volatile. It's too dependent on commodity risk. They're not doing it. So I don't think that's going to be a heavy lift. And then here we get to the exclusion question, the hammer that you raised earlier, Tony, which is that if managers or publicly traded companies fail to comply with the parameters that we're setting out here, then we'll bring those to the board and you guys will decide whether you want to exclude them or not, or do something else consistent with fiduciary standards. We're not going to ask you to make any decision that would violate your fiduciary duty. But that is on the table as an option if companies or managers say, no way, Jose. Okay, and I think that's it. There's an appendix with definitions of the financed emissions and the climate change solutions, which you can look at your leisure. And I will stop there.
Thank you, John. I want to say in the interest of time, I know we've already had a lot of questions. This presentation, along with the full climate action plan, is available for all trustees on the BERS SharePoint site. And the executive summary was in the packet that was sent to you before the meeting. I'm going to ask that we hold off on any other questions because we're going to be taking this up again in a month at the full board for approval because some of the net zero action plan will change until the full board needs to approve. Obviously, there's time for engagement with the Bureau of Asset Management, your consultants at any time throughout. But there is no meeting without John Matterich. And so in the interest of time, for action items, right, I should say, right, we can still have discussion, there'll be quorum, but we can't make any decisions without John Matterich. And so with that, I want to thank Mr. Adler and the rest of the BAM team for their presentation. Don't hesitate to reach out to them. I'm speaking for you, John. Reach out to them directly on all of that. I think it's really important. Like I say, it's one of the largest decisions that this board will make over the coming year.
I'd like to see the Makita report too. We'd like to see the
Yes, absolutely. We'll also send the Makita report. And that is from the SharePoint as well, but we'll make sure you have a link to it because that was buried. It's been a while. Absolutely.
Thanks a lot, folks. Have a great rest of your meeting. Bye.
Thanks, John.
So thank you, John. And so I'm going to call an audible because of that. We want to make sure we get to the action items prior to John Matterich having to leave. And so the next items I'm going to then ask if the committee is okay with us going into executive session now so we can get to the action items and then come back out for the discussion items in public session. Does that sound good to folks?
Yes, sir.
Fine.
All right, absolutely. So per Public Officers Law, Section 105(1)H, executive sessions may be held if the discussion is about the proposed acquisition of securities or sale or exchange of securities. With that, may I have a motion to enter executive session?
So moved.
Thank you, Tony. May I have a second?
Second from John.
Thank you, John. Any final discussion for public session? Hearing none, all those in favor of entering executive session, please say aye.
Aye.
Actually,
Aye.
All right. Any opposed? Any abstentions? Right. The motion carries. We are now in executive session. Before we get to the final item on our agenda, I'll report out on executive session. In executive session, the executive committee approved a commitment to 2 infrastructure funds and 1 private equity fund. The executive committee also discussed proposals related to an investment consulting contract. All right, so the last item on our agenda for today, for today's executive committee meeting, let me get my notes on this, is, lost place this in the script. Thank you. Next up, the last item on our agenda is an update on a decision made by the executive committee last summer with regard to a search for a global listed infrastructure manager. Do I have a motion to consider?
So moved.
Thank you, Tony. We have a second.
Second from John.
Thank you, John. All right, just give me 1 second to share my screen for hopefully the final time. All right. Can everybody see my screen?
Yes, sir.
And it does say global listed infrastructure ex fossil fuels, correct?
Yes, sir.
All right. So in 2021, BERS conducted New York City Retirement System's first asset liability study. Actually, let me start from the current slide. All right. And there were a number of conclusions. The first is that the median case showed that the plan was actually overfunded or could be overfunded at 5 and 10-year horizons, that there were very little downward pressure on contributions in overfunded scenarios, that outflows were 1 to 2% annually so that we could tolerate substantial illiquidity, and that the policy portfolio performs better than our current portfolio in median and downside scenarios. And so that's what we're going to concentrate on today. In May 2021, the BERS Board of Trustees resolved to implement the asset liability recommendations that include pursuing strategies to get BERS closer to its policy target. In real estate, that meant committing unallocated core real estate capital to a current manager in the portfolio, and to potentially re-examine the non-core real estate parking places. I'll define those in a second. In infrastructure, the recommendation was to issue an RFP for global listed infrastructure search on ex-fossil fuel search, and then select a global listed infrastructure manager. We talked about creating a strategy in the IPS for various funded ratios. That actually was rejected after the recommendation came about, so that is not in the current IPS. And also to integrate some of Siegel-Marco's ALM metrics into our annual reporting, including the funded ratio, the present value of employer contributions, and the economic employer costs. Today, what we're going to talk about is what were the ways and what are the ways that we tried to get to a policy portfolio. The first was to increase the minimum commitment size. So in 2016, BERS put in a minimum commitment size to private markets at 10 million. Prior to that, over the past 3 years, BERS had been getting investment commitments for as little as $2 million in the core program. And so as a result, the board at the time and our consultant, Siegel-Marco, put in a $10 million minimum commitment. The fund at that point was maybe at $3 billion. As the fund grew in size, the minimum increased. So in 2020, that minimum was increased to 25 million. The second was to find ways to commit to managers already in the portfolio. So to the extent that there was capacity in the portfolio, managers being able to commit to those managers to get to target, we thought was the path of least resistance. And then finally, if we weren't able to commit to managers that were already in the portfolio, using what's called the parking places that better match our private market characteristics. So what are parking places? So because private markets cannot be invested immediately, uncommitted capital is vested in what we deem as public market equivalents, which we deem the parking places. The parking places in reality are mostly an accounting and performance attribution convention, so you can kind of think about it as the opportunity cost, right? The opportunity cost of the public markets that best match the opportunity, the risk and return characteristics. So in private equity, the uncommitted capital is 100% invested in U.S. equity. In real estate, 50% U.S. equity and 50% U.S. bonds. And then in infrastructure, it's 50% global equity and 50% U.S. bonds. But to break down that even further, for infrastructure is 27% U.S. equity, 18% developed markets ex-U.S., 5% emerging markets, 5% U.S. treasuries, 10% investment-grade corporates, 10% mortgage-backed securities, and 25% TIPS. So as a result, particularly in real estate and infrastructure, we are oftentimes overweight core fixed income in our portfolio. And the thing is, why be concerned about that, right? Well, in general, core fixed income has properties that we like in the portfolio for a pension fund, right? current income, lower volatility, and in certain regimes, it has negative correlations. As we saw last year, that's not always the case. At the same time, we did not want to be structurally overweight an asset class as a lower expected return, right? And so again, while core fixed income provided these characteristics and properties to the portfolio, over long periods of time, being overweight an asset class that has a lower expected return just lowers your return. And so in conversation with our consultants, we decided on two courses of action. So in real estate, we did an allocation to Harrison Street, which is an open-ended fund that was already in the portfolio. Talked to the Bureau of Asset Management that of the open-ended core real estate funds, Harrison Street was the one that we had a fairly low amount. I think at the time it was something like $5 million. And so there was both capacity. It was at the top of our list for both Siegel Marco and Axia. Talked to the Bureau of Asset Management about it, and they worked through their process, and we ultimately got the allocation to Harrison Street to get us to our target. In infrastructure, instead, we decided on a global listed infrastructure search. To be clear, this was a recommendation even prior to from our consultants, even prior to the creation of BERS investment strategy, prior to the kind of the changeovers in 2018. So this has been something that had been discussed even prior to the office's creation, even back to the creation of the infrastructure asset class in the portfolio as a whole, which I believe started in 2011. And so global listed was a way to gain exposure to an asset class with higher expected return assets with the following characteristics. And so, listed equities, but they have lower volatility, better inflation protection, higher dividend yield. And we use it as kind of that opportunity cost while still being able to commit capital to the high quality private market funds recommended by the BAM infrastructure team. And so that gives you the context for the search. And so I'm actually going to now turn it over to Kristen Burnett, who can talk about the search overview and our ultimate rationale for selection. So Kristen, the floor is yours.
And thank you, Antonio, and hello, everybody. So as Antonio outlaid, I'm now going to speak about the search overview and rationale for selection. Next slide, please. Right, so in talking about the selection, first we have to speak about the RFP release. This was a collaborative effort between BERS and Siegel Marco. On December 15th, 2021, the New York City Board of Education Retirement System released an RFP initializing our investment manager search for global listed infrastructure with an ex-fossil fuel mandate. As a prerequisite, the participants were required to adhere to the following requirements. One, they had to upload their information to eVestments database to be considered by Siegel Marco. And then two, ensure that all of their firm information was current and accurate as of September 30th, 2021. It is of special note that the PPB rules were followed for this search.
One thing to note, PPB stands for the Procurement Policy Board.
Yes. So so once we received the shortlist from Siegel Marco, and we knew who our candidates were for the initial screen, which ended up totaling 11 managers. We sent out a due diligence questionnaire to each one of those managers. Of the 11, 6 managers actually completed the DDQ in our manager research and due diligence platform, Diligence Vault. The questions were formulated around the following categories, which the questions were a combination of questions that came from Siegel Marco and BAM's question bank. All right, the categories were firm background, team structure, products offering, philosophy and strategy, portfolio construction and process, portfolio analytics, and ESG considerations. The BERS investment strategy team then completed a thorough review of analyzing responses from eligible shortlisted managers. And then scoring was weighted on the relative importance of the category and the question being asked, which we will demonstrate in the next slide. So here, this gives you a glimpse into how we handled the scoring methodology. Typically, in an RFP, you may see that there is a split between qualitative and quantitative analysis at about 40-60 split. But what this allowed us to actually do is, one, assign an actual weight to each one of the categories, which encapsulates a number of questions. So you could call it anywhere from 5 to maybe 20 questions per category. Now, once we assign the initial weight to the categories, then if you look on the right, you'll see under the ratings column, this is where you can actually put in the questions with various conditions that may lead to other questions being asked. Now, the most important thing about this is we were able to assign a specific weight specific to the question being asked. So if it is a simple yes or no question, you can really weigh that down to, as you can see here, maybe less than 1%, because yes or no doesn't really move the needle unless it's a huge item that we need a yes or no on. But we were really able to distinguish based on the quality of the response by adjusting this weighting system to say, hey, all right, if we're in the philosophy and strategy section and a particular question has a response weighting that clearly is of more importance than it may be something that has a simple yes or no question, then we need to weigh it accordingly. And I think with this method, we were really able to see the best managers rise to the top of the pile, and other managers that may, on initial look through, maybe in a simpler process, may have seemed good. They actually didn't come through as well using this process. And I actually like where we landed as a result. Also keep in mind that after running this process, the team also has the capacity to provide customized reporting detailing our scoring for each question. Next slide. So now the finalist review and interview process. All right, on the right, you'll see that the 3 finalists listed. All right, and it is of special note that interviews were conducted with BERS trustees, Siegel Marco, and the investment strategy team present. All trustees received an invite to each scheduled interview. Upon scoring analysis, the finalists with the 3 highest scores out of 100 were brought in for interviews on May 16th and May 18th of 2022. All of the finalists adhered to providing performance over the various time periods with and without fossil fuel exposure in their global listed infrastructure portfolio for comparative purposes. Interviews were held for 2 hours per finalist. Finalists then provided a presentation outlaying the strategy, providing market perspective, and stating the case for why their approach is best fit for the BERS portfolio. Time was allotted for staff, consultants, or trustees to ask questions. Afterwards, the BERS investment strategy team and Siegel Marco deliberated on who would be the finalist selection based on all of the information provided. And then conclusively, based on the alignment of values, the strength of their team, performance, and their proxy voting transparency, the BERS investment strategy team and Siegel Marco advisors recommended that the board of trustees select First Sentier Investors as our global listed infrastructure manager. And let's get into the rationale. So in making this decision, here's a glimpse of the rationale with some slight comparisons to the other finalists. So First Sentier clearly outpaced the other firms when it came to, 1, their investment team, particularly the expertise of their portfolio manager, Rebecca Myatt. Her knowledge, passion, and clear understanding of the global landscape and how policy impacts market movement was second to none. Also, the stability of the entire team, those that have worked together for in excess of 15 years, and a well-staffed analyst team of senior and junior professionals really helped bolster the investment team case. Secondly, the price of the service, which is an obvious factor. When considering the complete offering, First Sentier ended up being the second lowest cost offering when projecting over a 9-year time horizon. It is important to note that so long as our assets remain under 200 million, there is no pricing difference between them and the lowest cost service, CBRE Investment Management. And I believe that in a projected scenario where we're assuming 7%, a 7% growth rate on the portfolio year over year for global listed, that would kick in at about year 7. And it would only be an increase, an increase in 5 basis points or decrease in 5 basis points, but very, very marginally small. Transparency, as their proxy voting history has demonstrated, that their votes are public and are never outsourced to a third-party advisor because it is done by the analyst. So with their proxy voting policy, they're taking complete ownership, and the team is well informed about what they're voting on. So you can hold them directly accountable and interview them directly about the viewpoints which they hold. A contentious issue brings up team-wide discussion. CBRE has some votes, comparatively, CBRE only has some votes, which may be available upon request, while the other finalists, Brookfield, does not release any of their proxy vote information. Next slide, please. Next, the ESG considerations. In considering the scope of the Net Zero Climate Action Plan, First Sentier represents a firm with the thoughtfulness, level of expertise, and engagement that aligns with the values of the board, in addition to successful management of a global listed infrastructure portfolio, excluding fossil fuels. An example of this is that First Sentier was one of the first movers with regards to integrating ESG in their infrastructure strategy since 2007. They utilize a quality ranking model that leads with ESG strategy as one of the three metrics that narrows a large investable universe, let's call that of about maybe 300 to 500 securities, down to a focus list of about 150 securities, of which they take 30 to 50 to make portfolio decisions on. And the ESG strategy has about a 24% overall weighting in their process. So while it is not the majority, it is fairly significant in moving the needle. First Sentier also keeps an internal scoring system, which is generated through meetings with company management. It is explicitly stated that there are consequences for a low ESG score. If issues of sustainability are not addressed, First Sentier may contact the board, vote against the company via proxy shareholder voting, or divest ownership completely or minimize ownership. Next slide, please. So lastly, where we stand right now, the board has already approved this. So now the questions are, how do we actually implement this? Currently, the BERS investment strategy team and First Sentier investors must complete the following: legal review of any materials, determination of the size of the allocation, which was designated at 100 to 150 million, finalizing contracting, establishing the separate account, and ultimately integrating it into our analytics system, CAISA. I think what will ultimately happen is that once we have established this relationship with First Sentier, we'll be able to have them, and the board will be able to interact with them and really get to pick their brain and see that they have a full expanse of knowledge around the globe, really. They're one of the most sociable, they have what I would call sociable intelligence about everything. So they're very personable, and I think the board will really enjoy conversations with them in the future. And if there's any questions, please feel free to ask. Thank you. Absolutely, Tony. No problem. We'll keep that in mind.
Any questions for Kristen? Hearing none. Look, I think that for us, what we wanted to do today was discuss our. So this selection was made by the board in June, I believe, right? June or July. So had the discussion. Well, I think the biggest thing we wanted to show was the thoughtfulness, I think, that went into the selection, the thoughtfulness of the process, the fact that this had been a something that had been on the agenda even kind of prior to the asset liability study, but the asset liability study, I think really, I think in the asset liability study, I think it kind of enhanced our kind of the resolve around it. And so, we had a lot of those discussions. Like I said, the board of trustees were involved every step of the way. The executive committee was involved in every step of the way. And so just wanted to give you all a kind of the rationale for it. And I would like to actually turn it over to our consultants for just a quick commentary because they were intimately involved in this.
Yeah, I think just from a commentary perspective, the process was followed similarly to prior processes where it's been consultant-led. And similarly, you heard today that when there's a public RFP, all 5 system consultants, provide their recommended list. That's what we did for this process. So we followed that same process that we do when BAM is involved. And I think that today you heard also from John on the climate change. I want to just let you know that First Frontier is an active participant in the Climate Action 100 that John mentioned, and it's been since its inception. And they already are reporting key carbon metrics for the companies that they invest in. So I just wanted to connect those 2 discussions together from this brand new manager. And I think I also would want to say that to complement some of Kristen's comment from a DEI perspective, when we look at managers, one area where First Frontier was ahead of all the other managers that submitted was their DEI. While they don't have a DEI head, they have a committee that's led by a committee, but the team that is managing these assets, it's 30% women and 20% ethnicity as part of the team that manages the infrastructure strategy. And that is the highest that we saw among the 6 managers that responded. So that is also in line with BERS and BERS strategy.
Excellent. Yeah, I have more questions about this, but I'm on a time crunch right now. But I appreciate the thoughtfulness of the process.
Yeah, and I think we're happy to, set up a call and go through the questions of the process and even share the documents. We had a full manager research report document, so I don't know if we maybe want to resend it to you all so you all can see it.
We have nothing else to read, but sure, definitely send it over.
Yeah, I know, it's the 70 pages, right? This one is not 70, I promise you.
Thank you. I know we're about 15 minutes out, and the thing is, I think we have one person on the call. I think 2 who were on the call who were on the executive committee at the time, who went through this process. So, if either of you have any comments, I think it was John and Russell. All right. Well, that's it for the executive committee meeting. That was the last item on the agenda. Is there any final discussion for the executive committee?
If people can get off, if you don't mind, I have a very quick question, but nobody has to stay for that other than you, Anthony.
I'll stay on. Absolutely.
Come on, Effie, I want to hear it. I'll wait a couple more minutes.
It's very quick. It's again like my ignorance how you guys do stuff. It's like asset allocation. So let's say we are very under invested in real estate because we're looking for deals and we didn't find anything. Are we allowed to invest, let's say, in a few REITs that are publicly trading, or is that like crossing into public equity and that's not really considered real estate? You know what I'm saying? Question of that nature.
So that's kind of the general, right? So in a lot of ways, kind of the listed infrastructure search kind of addresses that that question, right? That in the private markets, where are you going to be invested? Where are you going to be invested prior, if and when you're waiting for investments to private market investments to come across your desk?
Right, like can you park the money in REITs basically because that's more closely related than like government bonds, let's say.
Mm-hmm. So I think a couple of the funds still do have REITs. We actually don't have any exposure to REITs. And so what we did was, working with Axia, working with Siegel, working with the Bureau of Asset Management was use our quarterly liquidity, right? And obviously those have issues too, but some of the REITs do too, right? Some of the private REITs do as well. I think the larger discussion around the parking places is one that I think has implications, and that I think was a huge factor in the asset liability study, because while you could argue that you could maybe have some volatility matching by doing, let's say, a 60-40 or 50-50. To your point, the characteristics, when you set the strategic asset allocation, right, you're looking for certain characteristics, certain correlations. And then when, certainly TIPS, for instance, has some inflation protection, like infrastructure has inflation protection, or some of the core real estate. But to your point that, does the Russell 3000, for instance, have the characteristics that you're looking for when you're thinking about, or the MSCI Act, we have the characteristics that you're looking for infrastructure? It's like, is there a possibility to have something match that's a little bit closer, right? And I think that's your point. And so that's what this search was about. Because we had access to quarterly liquidity vehicles, that is, I think we thought that was kind of the best route for real estate, and to get us to target. But it's a very, very important question, because the more you have in the parking places, the more you're drifting from the policy that's been set. Private equity is less of an issue there, because of the higher return expectations. And because the program has been around longer, we've been able to get to target, right? And the parking place is something else that has I think high return expectations. Where it gets tricky, and I think this is the point you're getting at, is that a portion of it is in U.S. Treasuries, right? So a portion of it is, and again, while there are some characteristics that we really like about that, over the long period of time, right? If we believe in any type of efficiency in markets, is that our return expectations are what we're going to get from the asset class, right? And so if that's the case, being structurally, and because infrastructure and real estate don't have as high return expectations as equities or private equity, over time they're going to drag behind, and so you have to continuously. So we're going to have a hard time getting to that target. And so if that's the case, how do you increase that return expectation? Because we're underwriting infrastructure and real estate at higher than 40-60, right? Or like a 60-40 portfolio in our capital market expectations.
Yeah, can I just jump in quick, Antonio? Because Effie is pointing to something which came out of our asset liability study. Once you have identified an optimized policy portfolio and you have asset allocation targets, the best thing you can do is drive towards those targets. And it was our belief, and still is our belief, that to get to those targets, we may have to operate outside of BAM controlled space at the very margin. First Centier is one of those efforts to get to the policy asset allocation target efficiently and with some liquidity. So, this is what we're doing. We're not proposing this because we have an alternative that BAM is proposing. We're doing this because we haven't seen an alternative that BAM is proposing. We see it as a way to get to the policy allocation efficiently, intelligently, and favorably for the policy portfolio.
All right, thank you. I mean, we can get even more sophisticated another time. Like we can do it by all kind of like principal component factors and and stuff like that. But
we're gonna get you together with Salil and have we are having those conversations, Effie.
The other much simpler question is, do we have any problems with the flip side? Do we ever run out of dry powder? So we always have people contributing, right?
That's a good conversation to have long term.
We will, and we can walk you through kind of some of the cash flow analysis that we've done. But to your point about PCA, right? And because you're weighing kind of the risk factors, so right, like you're weighing some risk factors, and I think Salil's done some PCA analysis on this. I think he put it in the chat. But the thing that we're always trying to juggle, right, is having a ton of asset classes as the parking places is a nightmare for attribution, right? And so if we were to do an attribution analysis, or in the BAM reports that you received on SharePoint, they're doing attribution analysis through their State Street function and internally. When you do attribution analysis for and you have six or in this case 6 different asset classes, right? It is a nightmare to try and figure out your attribution and selection effect. right? And again, that's on the margins. At the end of the day, you really want to drive towards the risk return and correlation characteristics. But to have a, because now what we have to do is we have to add, all right, this 0.2% has to go to core fixed income, and this 0.5% has to go to, and so if you're talking to the trustees, it's sort of like, all right, well, why are we not at policy? And where is that money, right? And because they're constantly, the BAM folks who are doing transition have to constantly be buying and selling and so forth. It I think over time makes it difficult to do, I think, as rigorous performance analytics than we'd like. But we have a lot of material we'd love to show you. Again, the asset liability study, some of the modeling that Salil's doing, the cash flow study that we got from the actuary's office, that I think gets to a lot of your questions. I put in the chat if you have any times that you'd like to talk offline. Fantastic questions.
Greg Faulkner also, like, he encouraged me many times to go and meet you in person. I am planning to do it sometime soon.
Absolutely.
Doors wide
Thank
open.
you so much.
Okay. All right. So that's end of the and it's the last of the agenda items. If you need a motion to adjourn. We have a motion to adjourn.
Motion to adjourn from John.
Okay. Thank you, John. We have a second. Thank you, Russ. All right. All those in favor of adjourning, please say aye.
Aye, John.
All right. Any opposed? Any abstentions? We are adjourned. The next meeting is scheduled for Thursday, March 16th. Have a wonderful rest of your day.